Chapter 2, Cost Concepts and Behavior. So this chapter covers a lot of terms and concepts that are related to microeconomics. So if you've taken microeconomics already, a lot of these terms will sound familiar to you. So you'll want to be certain that you have a thorough understanding of these concepts before going forward, since understanding of the concepts is critical for the success in this course. But don't get overwhelmed with a new vocabulary. Just learn it as best you can for the class. You have to learn it for the class, but I really want you guys to at least be familiar with the terms so that in the future, if you work in cost accounting and run into these terms, you won't be totally lost. I want you to be able to say, oh yeah, that term sounds familiar. And if you don't remember the term, you can look it up and refresh your memory. Myself, I have to look up terms all the time. So a lot of this stuff, like I said, you need to learn it and have an understanding of it and be able to look it up in the future, but not necessarily commit it to long-term memory. So in this chapter, you're going to have to be able to explain the basic concept of cost. Now cost, a lot of people equate cost and expense and expenditures as all the same thing, but you'll find out in the next couple of slides that there's a difference between them. Second, you'll have to explain how costs are presented in the financial statements, so we'll practice on that in the homework. Third, we'll have to explain the process of cost allocation, which is dividing these costs up into their appropriate categories. Fourth, we need to understand how the material, labor, and overhead costs are added to a product at each stage of the production process. Fifth, we're going to define basic cost behaviors, and what that means is some costs act a certain way, like there might be fixed costs like rent, and some of them are variable costs, meaning that they go up and down with the amount of products that you put out. Some are semi-variable and some are step costs. So we're going to cover all that in the chapter. We're also going to identify the components of a product's cost, and then finally we're going to talk about a financial margin and contribution margin. The contribution margin is one of the terms I was talking about that you've heard in microeconomics if you've taken that already, and that's something that we're going to cover in this chapter. So what is a cost? A cost, as the slide says, is a sacrifice of resources. So when we buy one thing, we give up or sacrifice the ability to use these resources, for example cash, to buy something else. Now usually when we talk about cost, we're talking about an outlay of cash like we did on the prior slide, but it doesn't have to be cash, and we'll go through that in on this slide. So when we're usually talking about costs, we're talking about either outlay costs or opportunity costs. Opportunity cost is another term that is covered in your microeconomics class. So an outlay cost means that you're spending cash. When you're spending cash, that's also called an expenditure. So an outlay of cash is an outlay cost, and that can be either a past, present, or future outflow of cash. So that means that you might be spending cash now, or you might maybe sign your name to a loan or a contract, and that would be a future outlay of cash that you're going to pay out. It doesn't have to be now. It can be in the future. It can be in the present, or it can be in the past. An opportunity cost, on the other hand, is not an outlay of cash, but it's the foregone benefit from the best alternative course of action. So what does that mean? Let's say that you have you're offered. Let's say that you work at McDonald's, okay, and you're paid $15,000 a year, okay, and then I offer you a job after you get your degree for an accounting job, and I'm paying you. I offer you $50,000 a year. Well, I would think that all of you would take the $50,000 accounting job, which is why you're getting your accounting degree. But let's say if in theory, one of you says, well, no, I don't want that $50,000 accounting job. Maybe it's too far. Maybe I'm moving to another city. Something. There's a reason why you're not taking that job, and you say, well, let me just stay at my job with McDonald's. Well, if you stay with your job at McDonald's, you're making $15,000, like I said, and on your tax return at the end of the year, before taxes and everything and other deductions, it's going to show that you made $15,000 of income or $15,000 of profit, whatever, however you want to term it. Well, for accounting purposes and for tax purposes, you made $15,000. For economic purposes and cost accounting purposes, you actually made negative $35,000. And why is that? The reason is you have the skills and the experience and the knowledge to make $50,000. So according to economists and cost accountants, you should work in a job that maximizes the amount you can make, and you can make $50,000. But instead, you chose to work at a job making $15,000. So what that means is that it's actually costing you $35,000 to work at McDonald's. So you're taking home $15,000 profit, like I said, but you should be taking home $50,000 according to your skills and experience and education. Therefore, according to economists, your opportunity cost is $35,000. All right, so that's the difference between an opportunity cost and an outlay cost. Again, an outlay cost represents an outflow of cash. So that outflow of cash will ultimately end up on your financial statements. You're going to see it as some sort of expense, generally speaking. On the other hand, an opportunity cost will never show up on your financial statements. So this $35,000 opportunity cost, you're never going to see that marked anywhere on any books and records or in your tax return. You're going to know about it in your head, but you're not going to see it. It's not recorded anywhere. It's not a deductible type of cost. It's just a conceptual type of cost. All right, so we talked about costs and expenses. A lot of people, like I said, think that cost and expense are the same thing, and they're really not the same thing. A cost is a sacrifice of resources, and that could be an outlay cost or that could be an opportunity cost, whereas an expense, on the other hand, is a cost that's deducted on your books or on your tax returns against revenue in an accounting period. So an expense is a specific type of cost. You're going to see it on your books and records. Now, cost and expense, like I said, are not exactly the same thing. There's one example or one asset that's always used to show or demonstrate this difference, and that would be land. Okay, so let's say you buy a piece of land. You're going to spend money, right? However much that land is, let's say it's $100,000. You're going to spend $100,000, so that's an outlay of cash. You're spending $100,000. You're going to give it to somebody, and you're not going to have this $100,000 anymore. but on your books, it's not an expense. It's going to be recorded as an asset. Okay, so that's one thing that you're going to have to determine as an accountant in your future, in your careers. You're going to have to determine when you spend money, is it going to be an asset or is it going to be an expense? That's something that that accountants sometimes struggle with. If you remember, Enron Company, Enron was from Houston. Actually, Minute Maid Park, where the Astros play, used to be called Enron Field, I think before 2001. But there was a big scandal, back in 2001 because Enron was cooking their books, meaning that they were falsifying their books and records. The one thing that they were doing is they were capitalizing expenses or capitalizing expenditures. So what does that mean? That means that let's say you have someone that'll come to mow your lawn. Okay, let's say that you have a commercial building and you have some grass outside, some bushes, and you have someone come by and mow it every week, and trim the bushes and mow the lawn. So what you generally should record is you're going to record something like lawn expense, let's say $100, and then credit cash for $100, right? So you're recording an expense for this lawn service that you have, that you're taking advantage of. But what was Enron doing? Enron was not calling it lawn expense. They were calling it something like lawn asset, something like that. Now, it wasn't lawn service for Enron. It was many other things, but the concept is the same. There were some expenditures, some outlays of cash that were happening, and they should have recorded it as expenses, but instead they recorded it as assets. So what that did was their income statements were were inflated. So they were showing a lot fewer expenses, which would in turn show bigger profits. So their income statement showed bigger profits than they should have, and their balance sheets showed a ton of assets when they really didn't have any assets. So again, that's the difference between costs, expenses, and expenditures. Now this slide shows how operating profit is shown on financial statements. So in cost accounting, we're going to focus on something called operating profit. Operating profit, as it says, is the excess of operating revenues over the operating costs. Those are incurred to generate those revenues. All right. So again, for operating profit, that's what cost accounting is focused on. Now, when you look at your financial statements in your financial accounting classes, you're going to focus on something else, and that's going to be net income. So net income is it's similar. It's net income is very similar to operating profit, but it's the difference is that it doesn't include. Operating profit does not consider things like depreciation, interest, income tax expense, and other adjustments that's required by GAAP. So if you look here, this is a pretty simple income statement. You have your revenues. I don't know what you're selling here, but you made you have $32,000 in sales. It cost you you're selling services, okay? So your services, you made $32,000 in revenue. those services cost you $23,500. So your gross profit or your gross margin is $8,500, and then you had some marketing costs. You had to do advertising, it looks like, so you ended up with $4,200. But again, that doesn't account for the fact that you're going to have to pay income tax on this expense. You might have some interest expense. Maybe you took out a loan to help start up your business or to keep your business running. So again, those expenses are not included in the operating profit figure. So just be aware of that whenever you're comparing net income to operating profit. This next slide shows the financial statements for Southwest Office Products. So the slide before that was a service company, and this one is an office products company, kind of like a Staples or an Office Depot or an Office Max. So one thing you'll see different here is that in this on this slide they call it cost of goods sold, whereas in the prior slide you had cost of services sold. All right, so that's one of the differences. You're going to change the name of your main expense account depending on what type of business that you have. So so again, this is Southwest Office Products, and this is going to be some sort of retail or wholesale firm. So when you're buying food, clothes, or a book, something like that, you're buying from a retail or maybe a wholesale firm. These firms, they sell items, you know, like Target and Walmart, for example, but they don't make items. They don't make a tangible product. It's just for resale, generally speaking. I know that some stores nowadays, like Kroger and H-E-B, they do make products, but generally speaking, retail and wholesale firms, they don't make a tangible product. So the income statement for these companies include the revenue and cost of items, just like service companies, but for retailers and wholesalers, it has an added category of cost, which is cost of goods sold. And the cost of goods sold, as you'll see, is broken down into a cost of goods sold statement that'll give you additional information about the product that you buy and sell. So again, for this slide, Southwest Office Products, we're talking about a retail company that sells office supplies such as paper products and computer accessories. And so shown here is the income statement as well as the cost of goods sold statement. And this cost of goods sold statement, it just breaks it down. You know, it would be very simple if all of the companies like Kroger and Walmart and Target, they sold every single item that was on their shelves on December 31st, and then purchased all new inventory on January 1st of the next year. But unfortunately, it's not like that. So that's why you're going to have beginning inventory, you're going to have ending inventory, cost of goods sold, merchandise costs, and some other figures that you're going to have to consider when you're calculating the actual cost of goods sold expense. So the term cost of goods sold, that includes only the actual costs that were actually sold. So if you look at the difference here, you have cost of goods available for sale. That means that this is the amount of goods that were sitting on your shelves at any point during the year. But then cost of goods sold is the amount that you actually sold. So you had $2,220 worth of goods on your shelves at some point during the year. You only sold $1,775, and you still have $445 worth of goods sitting on your shelf on December 31st. One thing you'll notice is that these costs, this is how much that the company spends to purchase the items that they sold, to transport the items as well. It does not include stuff like the salary of the salesperson, which would be considered marketing costs, or the salaries of the executives, the president of the company, which would be administrative costs. So it only holds specific things like again the cost of the merchandise and transportation. All right, this next slide is going to show a manufacturing company, Jackson Gears. So we've talked about a service company, we've talked about a merchandise company, and now we're going to a manufacturing company. And these are going to be a little bit more complicated because a manufacturing company actually makes the product that it sells. So we talked about Target and Walmart being merchandise companies, but they, a lot of these Targets and Walmarts do have their own bakeries, so they do make some of the products that are sold in their stores. And also all these restaurants, Pizza Hut, McDonald's, Taco Bell. I worked at Pizza Hut for 4.5 years off of Fairmont and Burke, and I never knew this until I started working for the state of Texas as a sales tax auditor. But Pizza Hut and any other restaurant are considered manufacturers, and if you think about it, they meet the definition of a manufacturing company because they make the product that they sell. So if you think of just a gas station with no sort of kitchen or deli inside, all they do is resell the snacks that it buys. They're not a manufacturer, but the gas stations that do have the kitchens in the back and they cook the food, then those would be considered at least partially a manufacturing type of company. So financial reporting distinguishes costs in a manufacturing firm based on when the costs are recognized as expenses on the financial statements. So we're going to get into that on the next slide, but we're going to talk about product costs and period costs. So product costs, they're going to be costs that are capitalized, and then period costs are expensed in the period that they're incurred. And if you remember, what we meant by when we say that a cost is capitalized, that means that we're going to call it an asset for the time being. So again, product costs, these are costs related to the inventory, so they become part of your inventory. So let's say that you're a furniture maker and you have to buy paint to paint your furniture. That paint is going to be considered a product cost, so that's going to be added to your assets. So paint is an asset, and that's going to be recorded on the balance sheet as an asset. So again, these are capitalized costs. So it's money that you spent, but you're going to capitalize it, which means that you're calling it an asset for the time being. A period cost is something that's expensed in the period that it's incurred. So here you have it shows you, I guess, a boardroom. Maybe they're the executives of the company or the salespeople. Those aren't capitalized. Those are going to be expensed as incurred. So again, a product cost is capitalized. A product cost is also referred to as a manufacturing cost, or you might see it called an inventory cost because it's included in your inventory amount. And then a period cost is a non-manufacturing cost. So again, a product cost is capitalized. A period cost is expensed. So again, this slide just repeats what we've already talked about. Product costs are recognized as expenses on the income statement as cost of goods sold when the product is sold, and period costs are recognized as an expense when incurred. So again, product costs are capitalized, and period costs are expensed. Now, some people at this point, they might ask, what's the big deal? You're going to get to deduct a cost in the long run anyway. Either you deduct it now or you deduct it when you sell it, but you get a deduction anyway. And that is a valid observation, but GAAP wants you to recognize costs when they're supposed to be recognized, and the IRS and in Congress want you to recognize costs and expenses according to what they have legislated. So you just can't pick and choose when you're going to recognize a cost and when you're going to capitalize it, if you're going to capitalize it and if you're going to expense it. You do have rules that you have to follow. Like I said, in the long run, it's going to get deducted one way or the other, but they don't like you playing with your numbers. So a lot of times you might see accountants when they're on the stock market, they aim for a certain profit. So, maybe investors think that your company is going to make a 5% profit in a quarter, and then you're the manager of that company, and your bonus is tied to that 5% profit. Then you might manipulate the numbers to try to meet that 5%. And that's something that is always going to be a struggle ethically for accountants, but there are rules in place. So generally speaking, it's pretty difficult to really fudge on the numbers a lot. There's always going to be a little bit of room for error and a little bit of room judgment-wise, but generally speaking, the rules are set so that these accountants don't fudge the numbers too much. All right, now we're going to get into direct and indirect costs. These are product costs, but they are further classified into direct or indirect. Remember that product costs are manufacturing costs that are recognized as assets in inventory when the costs are incurred, and they're expensed as cost of goods sold when they're actually sold. Now, for direct costs, we have direct materials and direct labor. Direct materials, they're directly traceable to the product. So, for example, I audited an airplane manufacturer back in 2007, I think. And this airplane manufacturer, they can trace every single part that goes in the airplane. So up to the little screws in the airplane, they know exactly which screws went into the airplane. They can directly trace each material. Now, most other things you can't trace the screws or whatever, but in this case, it was an extreme example of direct materials. Just in case there's a plane crash, they want to be able to try to find out exactly what part failed, if a part failed, and how it caused the crash. So direct labor is similar to direct materials in that you can trace the person working on a certain product. So let's say you have an artisan furniture store. Everything is made by hand. So you might have, if you have one certain person to build one certain chair, and then you can trace exactly, okay, well, this person built that chair, so if something goes wrong, we know exactly who built it. And so that would be an example of direct labor. Now, some costs are classified as indirect costs. Indirect costs, these are costs that can't be directly traced to the product. So they're going to be classified as manufacturing overhead. Overhead is comprised of all of the production costs, except for direct materials and direct labor. So they're going to include indirect materials, indirect labor, and other indirect costs. So going back to the furniture example, let's say you use wood to build your furniture, solid wood, and maybe you're as meticulous as that airplane builder that I mentioned, and you're able to trace every piece of wood to each piece of furniture that's built. So that would be a direct material, right? But you know, what about something like glue? Furniture builders use wood, but they also use glue. And do you think they can trace every single drop of glue to each piece of furniture? Probably not. So in the case of glue, that would probably be considered an indirect material, and so that would be just applied to manufacturing overhead. All right, and then here's a couple more terms for you guys to learn. This chapter is full of new terms. We have the term prime cost, and we have the term conversion cost. And if you'll notice, there's an overlap here. See, direct labor is part of both of them. So when you're talking about a prime cost, if you get a question in the homework that says what are the prime costs of a certain product, they're asking you to add up the direct materials and the direct labor. These are called prime costs, or aka primary costs of the product. They can be directly traced to the product, and so that's the term that's used for direct materials and direct labor. Conversion costs, on the other hand, that includes direct labor and manufacturing overhead. So why do they call it conversion costs? Well, in other words, you have these raw materials. You have wood, you have glue, you have a metal, whatever you have, and what do you need to convert them into the final product? Well, you're going to need direct labor, and you're going to need manufacturing overhead to convert this raw material into the final product. So direct labor and manufacturing overhead are considered conversion costs. So again, there's 4 boxes here, but only 3 different categories: direct materials, direct labor, and manufacturing overhead. Now we're going to get into period costs. So period costs, identifying them, they're not quite as complicated as product costs, but they are necessary. Okay, so period costs are costs that are necessary to sell the product and operate the business. These costs are recognized as expenses when the costs are incurred. So they're not part of inventory. They're not inventoried costs, but they're expenses immediately. So you have marketing costs, selling costs, etc. Like I said, those are necessary to sell the products, but they're just not considered a product cost. You have marketing, which consists of advertising, sales commissions, shipping costs. You have administrative costs, which are costs necessary to operate the business. Like I mentioned earlier, you get your president, vice president, CEO, CFO. They're gonna have salaries. Also, if you have a big enough company and you have an IT department, you're going to have data processing costs, you're going to have legal costs. So there's a lot of costs to running a business. These costs, again, are not considered product costs because they're not directly related to the product, but they are necessary to run the business. So they're not something that you can just ignore. But they're not. You just need to know that they're not inventoried, they're not capitalized, they're expensed when they're incurred. So it's pretty easy to allocate direct costs because you can trace the cost directly to a product. But what about these indirect costs? They can't be directly traced to a product or to a cost object. So they need to be allocated in some form or fashion. So so what we're going to do here is we're going to talk about how these costs are allocated, and there's going to be 3 steps that we're going to allocate. Step number 1 is we're going to define the cost pool, which is a collection of all the indirect costs to be assigned to the cost object. We're going to determine how we're going to allocate these costs, and then finally we're going to actually assign the costs to the cost object. So here are the steps on this slide. Again, it shows that we're going to, the first step is to define the cost pool, and then we're going to determine the cost allocation rule, and then we're going to have to assign it to the cost object. The cost object can be something like certain departments, or maybe if you have several locations, each location might be its own cost object. I know that, again, these terms can be confusing, but I think once we get to the examples, they're going to be easier for you to understand. All right, so let's look at this example, which is also in your book on page 47. Rockford Corporation has 2 divisions, East Coast and West Coast, and both divisions are supported by the IS group. Some companies call it the IS group, some call it the IT group, but IS stands for Informational Systems. In this case, the IS group is costing the company $1 million. So when you have something like IT, you know, the people that helped out with the technology of the company, you can't really allocate it to a product. Okay, so again, going back to the manufacturer of furniture, you can't say, well, this IT person belongs to this rocking chair, and this IT person's salary belongs to that rocking chair. It's not traceable in that manner. So what do you have to do? You just pool together all of the expenses for the IS department. So in this case, your cost pool is the entire IS department, and that costs you $1 million. All right, so that's step number 1. Determine the cost pool, and that pool is the department's cost of $1 million. Now, the cost allocation rule is, okay, well, we have the total cost of $1 million, but now how are we gonna allocate it? Well, in this case, they decided to allocate it based on divisional revenue. So you have 2 divisions, East Coast and West Coast. East Coast makes $80 million in revenue. West Coast makes $20 million in revenue. So what happens? They're going to divide this $1 million of cost. They're going to put 80% of it to the East Coast and 20% of it to the West Coast. So is that the best way to do it? The question doesn't give us enough information to determine whether it's the best way to do it, but it's one way to do it. All right, so you just have to pay attention to these questions to see how exactly do they decide to allocate costs. In this case, they decided to use divisional revenue, but they could have decided to do number of employees. That would make sense. So if East Coast and West Coast both have the same number of employees, then it would be a 50-50 split. Or maybe they don't do a number of employees, but maybe there's only certain people in the company that uses laptops or technology or whatever else the IS department is taking care of. So in that case, they might split it out split it out in that manner. So maybe the East Coast has more people to use laptops than the West Coast, or vice versa. Whatever it is, there's different ways to allocate these indirect costs. All right, this slide, what I want you guys to pay attention to is the 3 different inventory accounts. All right, so again, a manufacturing company has 3 inventory accounts. They have their raw materials account, they have their work in process, and they have their finished goods. So it's pretty self-explanatory. Again, going back to the furniture maker, when he buys his wood, that's going to go into the raw materials account. When he's, let's say it takes a couple months to build a certain piece of furniture, maybe it's a rocking chair that the wood needs to be soaked and then bent, something like that, then the raw materials would then be allocated to the work in process inventory. And then finally, when the product is done, it's allocated to the finished goods inventory. So again, a manufacturing company has 3 different inventory accounts, whereas a retailer is going to just have 1, or a service company is just going to have, well, the service company is not going to have any inventory account, generally speaking. All right, now we're going to talk about the way costs can behave. The costs can change based on the amount of volume that your business does. It might change, or it might stay the same, or it might. There's several ways where or how a cost can react, and we're going to go over for the 4 different cost behavior patterns. So the first one is your fixed cost, and that's going to be a cost that remains the same no matter what. Well, I say no matter what, but it won't change within the relevant range, and I'll explain that further in a second. But generally speaking, when we're talking about fixed costs, we're going to talk about something like rent. Okay, so let's say that you own a restaurant, and it seats 300. There's 300 seats in the restaurant. Well, it doesn't matter if you serve 1 customer this month or 300 customers this month, or whatever time period you're talking about. You're still going to pay your rent for the month. Okay, doesn't matter if you serve 1 customer, 1,000 customers. If you decide to shut down and go on a two-week vacation, or if you open 24/7, generally speaking, your costs are going to be the same. And that's this is demonstrated in the graph here. So in this case, this fixed cost, let's say it's rent. Let's say it's $25,000. Okay, and it doesn't matter if you had 1 customer, 2 customers, 3 customers, 4 customers, whatever. It's still going to be $25,000. Okay, so again, fixed cost means that within the relevant range, the costs are not going to go up or down according to the volume of business that you do. Another way costs can behave is variable. So variable cost, that's something that changes in direct proportion with a change in volume within a relevant range. So what does that mean? Usually we're going to talk about a product cost. All right. So remember a few slides ago we talked about cost of goods sold, and the cost of goods sold is only recorded whenever you actually sell a product. So if you don't have any sales, you don't have any cost of goods sold. Then if you sell one item, then you can deduct, you can expense the related cost of goods sold to that one item, two items, and so forth. But again, cost of goods sold, if you sell nothing, you also have zero cost, and then if you sell one item, you're going to have a certain amount of cost here, two items, and so forth. So it varies directly with how much you actually sell, or how much volume of business you actually do. A third type of behavior is semi-variable cost. Now, something like this, it's something that's both partially fixed and variable, and it includes mixed costs. It's also, it's also known as mixed costs. So, what would be something like this? I think the easiest example to think of is electricity, or your utilities. Okay, so your utilities, the more you for electricity, the more electrical gadgets that you use, the more electricity you use, and then the higher your bill goes, right? But let's say you decide to go on a vacation, a 1-month vacation out of state, and so you unplug everything. You unplug the refrigerator, which is not smart, but let's just assume you did that. You turn off your AC. Again, that's not very smart in Texas, but you can get mold in your house if you don't run your AC at all. But again, let's just say you did that as well. You unplug your refrigerator, you turn off your AC, you unplugged every single thing in your house to save on electricity. You get back home a month later, and then a few days later you receive your electric bill. And is your electric bill zero? No, it's not going to be zero. There's going to be still some costs you're going to have to pay. So you might be a little bit upset about that with the electric company, but again, electricity is something that's considered a semi-variable cost, because you're going to have some sort of starting point, some sort of minimum charge, and then from there, depending on how much you use, it's going to go up, right? It's going to increase, but just to compare the two charts, this chart at zero volume has a cost of 10. Okay, if you look at the prior slide, a truly variable cost at an activity level of 0, your cost is also 0. All right, so that's the difference. At first glance, the two different charts look exactly the same, but when you look closer, you can see that one starts at the origin point, which is 0, and the other starts at a different point. In this case, it was a cost of 10. Right. Another type of behavior pattern is known as step costs. So these are going to be costs that increase in total with steps when the volume changes. So like I said earlier, there's a concept called a relevant range. So if you're looking at a range, let's say from 0 to 1, this range right here, that looks like this is flat, so that looks like the first type of cost, the fixed cost that we talked about, right? But when you expand your relevant range to include a bigger amount of activity, the relevant range expands. So you also see that costs tend to behave a little bit differently. So earlier when I said that rents are a type of fixed cost, they are, but but only within a relevant range. So what does that mean? So let's say your restaurant holds 300 people, and it doesn't matter if you serve one person, 0 persons, or 300 people, your rent is still the same. Well, what if your business gets so busy that now you're serving 400 people a day? Well, then you're going to have to rent a bigger place, get a second location maybe. So that's going to be an example of ultimately a variable cost. You increased your relevant range, you increased the number of potential customers, so now your costs, your fixed costs can actually go up. So what's a good example for step costs? Well, again, I worked for Pizza Hut for about 4.5 years as a driver. I did the phones as well, and also was acting manager whenever the real manager stepped outside. I worked for Pizza Hut mostly as a driver for 4.5 years. So, so let's say each shift you have to have at least the driver, at least one cook, and at least one manager. Okay, and for this example, let's just focus on the cook. Well, so the cook can cook a certain amount of pizzas in an hour, right? So if business stays within this range, you only need one cook. Doesn't matter if no people order that hour, or if let's say this is by 10 to 10, 20, 30, and 40. Let's say only if 0 people order or if 10 people order, that's all fine. One cook can handle it. Well, let's say that that hour you have 11 customers. Well, 11 customers, one cook can't handle, so then you have to call in a second cook, and now you have you've gone up a step. Okay, so you can't ask half a cook to come into work. You have to have a whole cook, obviously, and hopefully that there's enough business to pay for that second cook's wages. If not, that's just part of doing business. But anyway, so that's going to be like a step. So again, if business is within this range, you need one cook. If business is within this range, you're going to need 2 cooks. And if business grows to this range, you're going to need 3, and this range 4. All right. So those are steps where you can't cut it down incrementally. You can't just say, "Hey, cook, can you come in here and make this one pizza and then go back home? And if we need you again, we're gonna call you again." Really doesn't work like that. Depending on the level of business that you anticipate, you're gonna have to call in more people to come in and help. So that's an example of a step cost. All right, here are more terms that they want you to learn for this chapter. I'm telling you this chapter is full of terms that you're going to have to familiarize yourself with. And this is going to be ways that you can identify the components of the product's cost. The first one is full cost, and in full cost you're going to consider all the costs for manufacturing and selling a product. Okay, so it's the most complete way to measure a cost per unit. For absorption cost, you don't look at selling costs. You just look at manufacturing cost. Okay, and then for variable cost, you don't consider your fixed cost like you did in full absorption and full cost. You're just going to look at variable cost. Alright, so this chart illustrates the difference between the two. Again, full cost includes includes both manufacturing costs and selling costs. These are going to be your selling costs down here. Those are, again, costs that aren't directly related to manufacturing of the product, but they're definitely necessary. Full absorption cost excludes the selling costs and only includes manufacturing costs. And then your unit variable cost. It includes both selling costs and manufacturing costs, but only the variable cost. So as far as fixed cost goes, it's not included in that figure. For GAAP purposes, when you're doing your financial accounting, they want you to use full absorption costing. All right, and that's going to be sales revenue minus cost of goods sold to get your gross margin. And then for variable costing is used for cost accounting purposes, generally speaking. It's used for managerial purposes and internal decision making. And if you notice here, the formula is similar. You do start out with sales revenue, but you only subtract your variable cost and you get your contribution margin. So what is contribution margin? The book tells us that contribution margin is your sales price minus variable cost. And that seems like a very strange term, contribution margin. What does it mean? It's just every time you sell a certain product, how much profit, how much does it contribute to cover the fixed costs and earn a profit? So that's where the term contribution margin comes from. Each product is going to contribute a certain amount towards the bottom line, the profit of the company, or to cover its costs. I personally don't like the term, but the concept makes sense. But I wish they could come up with a different term. So that's going to be different from gross margin. It's similar in that it's ultimately calculating the profit per unit, but it's but when you're doing gross margin, it's adding in a bunch of other costs which are necessary, whereas for contribution margin, it's just doing the bare minimum, and again, it's only used for cost accounting purposes. And then these last two slides show the difference between full absorption costing and variable costing. In full absorption costing, you start out with sales revenue, and you subtract cost of goods sold to get your gross margin. Then you subtract out your marketing and administrative expenses, aka your selling expenses, to get to operating profit. When you compare that with the next slide, which looks very similar, but and you arrive at the same bottom line, which is operating profit, but you get there a little bit differently. You start out with sales revenue, you subtract cost of goods sold. Under full absorption, that's going to include variable and fixed manufacturing costs. Then you subtract out your marketing and administrative costs, which are your period costs, to get to operating profit. So in both cases, you end up with the same amount. Under variable costing, variable is subtracted first, and then fixed is subtracted second. Whereas under full absorption costing, you have variable and fixed on both the top and the bottom. The difference here is that manufacturing costs are going to be split out from marketing and administrative costs. All right, so let's begin the homework. Again, if you haven't worked the homework yet, I would highly suggest that you attempt it before watching me work out these problems. I think that you get the most benefit out of attempting them first before you watch the video. Another thing to keep in mind is that these questions are algorithmic, meaning that you guys on your homework are going to have slightly different numbers than I have. But again, if you just try to understand the concepts, this should help you anyway. And the numbers aren't going to be that far off either. All right, so question 1, Intercontinental Inc. Gives us some data for its product that it makes. It gives us a sales price per unit. On mine, it's $51. It gives us fixed cost per month, SG&A, manufacturing overhead. It gives us variable costs, direct labor, direct materials, overhead, and SG&A. And then the number of units produced per month, which is 300,000 units. And it wants us to calculate a lot of these terms that we covered on the slides: prime cost, contribution cost, gross margin, and so forth. And it wants us to calculate it based on the 300,000 unit production level, as well as a 400,000 unit production level. So I think you guys can get a lot of these on your own. So I'm not going to do every single one, but I'm going to do the ones that I think you're going to have, that you might have problems with. But before I do that, I want to demonstrate to you guys something. Demonstrate to you how fixed costs can be a little bit tricky. So let's say that we have rent for $100,000. Okay, and let's say we only create one item for the month, right? Let's just say that we only make one item for the month, so that one item is going to be allocated the entire $100,000 cost. Okay. Now let's say in another month we have $100,000 rent, and we make two items. So now each item is going to be allocated a cost of $50,000. So in month 1, it was $100,000 cost per unit, and month 2 it was $50,000 per unit. So you might ask yourself, well, wait a minute, I thought these costs were fixed. Well, they are fixed. The total is fixed. This $100,000 total is fixed, but cost per unit is going to change. So if you make 0 items in a month, or 1 item in a month, or 1,000 items in a month, the overall total of that fixed cost is going to be fixed. But when you break it down to per unit, it's going to change. So keep that in mind for fixed cost. And when you're talking about variable cost, the cost per unit is constant, but the total for the month is going to change. So those two flip-flop. Again, for fixed cost, you have a fixed monthly amount, but a changing per unit amount. But for variable cost, you have a fixed per unit amount, but in a changing monthly amount. All right. All right, so let's start with the number 1. Again, I'm not going to do all of them. Well, I'm just going to do a few of them. One of them I'm going to do is the full cost per unit. And if you go back to this, our slides, or if you look in the book, full cost of unit, that's the sum of all manufacturing and selling costs. Okay, so we're going to have to look at all of these costs. Um, so let's take a look. All right, so again, full cost is the most complete cost method. It includes manufacturing costs as well as selling costs. So we're going to add all of those up. So the question tells me, in my question, it says that I have direct labor of $6, direct materials of $13, manufacturing overhead of $9, and then variable SG&A of $4. Okay, so these are my variable costs per unit. Add those up, and I get $32. Now, so those are the variable costs. But there's also some fixed costs, and these fixed costs are not broken down per unit. They're given per month. And for fixed costs, it tells me that I have SG&A of $900,000 and manufacturing overhead of $2.7 million. So that's going to add up to $3,600,000. Okay, so that's my total amount for the month, but I have to break it down into a per unit amount. So in the first case, we're going to divide by 300,000 units. Okay, we do that math, and we get so we get $12 in the fixed cost, and so from this point we just add the two amounts. We add $32 and $12, and we get a $44 cost per unit, full cost. Okay, so that's for 300,000 units. Now, the question also wants us to calculate for 400,000 units. So when we're doing 400,000 units, our variable costs are the same, like I said earlier. The cost per units are the same, but our fixed cost per unit is going to change because we're going to have to divide by a different number. So our monthly costs are still the same. It's still going to be $900,000 for SG&A and $2.7 million for manufacturing overhead to give us $3,600,000. But this time we're going to divide by 400,000. And we're going to get $9. Okay, so when we add $9 to $32, we're going to get a $41 per unit full cost. All right, so again, that demonstrates the difference between variable cost and fixed cost. Variable cost per unit is going to stay the same, but the monthly amount changes. Fixed cost, the monthly amount stays the same, but the per unit amount can change. All right, so that was question number 1, part H, full cost per unit. Now I also want to do full absorption cost per unit, which is part F. And if you look at the the book, it tells us that for full absorption cost, we're not concerned about selling cost. We're just concerned about manufacturing cost. So we're gonna so it's all we're doing is looking at manufacturing cost. So how does that change what we've done so far? Well, for variable cost, full absorption cost is going to include direct labor, direct materials, and overhead, but it's not going to include selling cost, because like I said, it only includes manufacturing cost. So that's going to change our answer here. Instead of $32, we're going to have $28 in variable costs. It's also going to change our fixed cost calculation, because we're not going to consider selling cost here either. So we're going to take that out, and we're just going to deal with the $2.7 million manufacturing overhead. So now all right, so now we have our $28 variable cost. Now we do the math. Our $2.7 million divided by $300,000. 300,000 units. So that's going to give us $9. And so we add these two, $28 and $9, and we're going to get for F $37 per unit. Okay, so that's going to be question 1 part F for 300,000 units. If you're going to do it for the next for 400,000 units, your variable calculation stays the same, but for fixed costs, instead of dividing by 300,000, you divide by 400,000. Alright, I also want to do part D, which is conversion cost. And for for conversion cost, if you remember the slide on conversion cost, that includes it's the costs that are incurred to convert your raw materials into the final product. And to convert raw materials, you're going to need your direct labor and your overhead. All right, so so no selling expenses. So how do we calculate this? Well, first we're going to have to get rid of our direct materials, because that's not part of the figure. So we have our variable direct labor, and then our variable overhead. So that's going to be $15 here. Our fixed cost, we still have our manufacturing overhead of $2.7 million. We're going to divide that by 300,000 units, so we get $9 of fixed cost per unit. So then we add these two amounts, $15 and $9, and we get $24 of conversion cost per unit. All right, and then, as I said, when we're calculating for the 400,000 unit production level, your variable calculations stay the same, but you're gonna, instead of dividing by 300,000, you divide by 400,000, and you're gonna get a different figure. You should get, in my case, with my numbers, I get $21.75. And then I'm also going to calculate the gross margin per unit, and that one is calculated by doing the sales price minus your full absorption cost, which we already calculated. Remember that full absorption cost, that's going to include your fixed and variable cost of manufacturing, but it's not going to include any selling cost. And so for the 300,000 unit production level, we have a sales price of $51, which the question gives us. And we've already calculated our full absorption cost on part F for $37. So in this case, we just do 51 minus 37, and we get a gross margin of $14. All right, so that's your answer to part C. The other ones I think you can do on your own in question 1. If you have any questions, feel free to send me an email, but I think you should be able to do those fairly easily on your own. All right, for question 2, they want you to make a cost of goods sold statement. I'm not going to do that for you. You have a good example on page 50, so I would just follow that. It's going to be in the same format. So that's just good practice for you. Question 3, this is going to be similar to question 1, where it gives you variable costs and fixed costs. And then they want you to calculate total fixed cost, total variable cost, and then unit costs. So for this one, again, remember that cost of unit for variable costs are going to stay the same. So if it tells you that, you know, a variable cost is $10 per unit, it's always going to be $10 per unit. But for fixed costs, that's going to change per unit, because for fixed costs, they're going to give you the amount for the month, and then depending on whether you create 15,000 units or 21,000 units, you're going to have to divide that monthly total by that amount to get your per unit amount. So that's going to change, and that's going to be the tricky part in the question. But if you understand question 1, you should be fine on question 3. Question 4, this one they want you to prepare an income statement based on gross margin, and then one on contribution margin. And this one is a good example on Exhibit 2.14, and that's on page 60 of your book. Again, it's almost identical, the format in the book as to what they want for your homework, with the numbers changed. So I'm going to let you guys do that on your own. Question 5, this one is going to be similar to question 1 again. So if you have any questions on this, if you get stuck on something, let me know, and I'll be happy to work it out for you. Again, I always recommend that you find a partner to work with in class, and then that way you can bounce things off of each other. But if for some reason you can't do that, feel free to send me an email. And then so we get to question 6, which is the last question. Now this one is 2 parts, and I'm going to do 1 part for you, and I'll let you do the other part on your own. So on this question, it says that your company is called Coastal Computer. You have 1 location on Main Street, 1 on in Lakeland Mall. You have an accounting department for your company. Your accounting department, according to my question, the cost is $200,000. Again, these questions are algorithmic, so your numbers might be slightly different from mine. And then it wants us to allocate this $200,000 based on computers sold, and then based on store revenue. So again, I'll do the first one, but I'll let you guys do the second one on your own. So the question, according to my fact pattern for Main Street, numbers sold for me is 2004.18 for Main Street, and then for the mall was 1,482. So total computers sold is 3,900. Okay. The accounting department cost was $200,000. So it says that we are allocating this $200,000 based on the number of computers sold. So how do we do that? It's really pretty simple math. The first one we're going to do 2,418 divided by 3,900, and that gives us 62%. Okay, so if you do 62% times $200,000, that gives you 124,000 for Maine. And then for Lakeland Mall, you do your 1,482 divided by 3,900, and that gives you 38%. And then so you do 38% times your 200,000, and that gives you 76,000 for the mall. So you can check this work by you can add these two up, 124 and 76, and that gives you 200,000. Or you could even shortcut it a little bit. You know, you did your first calculation here, you got your 124,000. From this point, you could have just done 200 minus 124 to get 76. However you want to do it, you know, you can whatever's easier for you, do it that way. You can do it a couple of different ways just to check yourself, but that's how you would allocate based on the number of computers sold. The second part is to allocate based on store revenue, and it's going to be the same thing. Instead of using the number of computers, you guys are just going to pop in the revenue amounts. You're going to get a total. You're going to do your fraction here, get your percentage, and then multiply by the cost to get the amounts per store. Again, if you have trouble, you know, feel free to send me an email or post on the discussion board. But I think you should be able to handle this question as well. All right, so that concludes Chapter 2. If you need anything as usual, feel free to send me an email. And if not, I'll just see you for Chapter 3. Thanks.